In 2008, S&P 500 earnings dropped by 70%. In 2001, S&P 500 earnings dropped by 40%, both leading to significant corrections on the S&P 500. These drops in earnings can have a devastating impact on the stock market's performance, and although they've climbed higher consistently over the last 80 years, we've seen multiple moments throughout history where S&P 500 earnings declined by 20% or more, around 13 instances in total, pretty much all of these occurring around recessions, and some of these leading to substantial drops in the stock market, but some of them didn't lead to any decline in the stock market whatsoever. So we're going to dive into history to understand whether a drop in earnings in 2024 would actually lead to a big drop in the stock market, something we haven't really seen since COVID-19, or whether the stock market could actually continue to climb higher despite a recession occurring, because a global recession or a hard landing is the most significant concern among fund managers today. A third of fund managers in this survey said that a recession was the biggest risk for the market because that would cause earnings to go down like in 2000 and 2008. But when we go back just a little bit further in history, we see that in 1990 and 1985, earnings were going down, but the stock market was experiencing these incredible rallies. We even had a full-blown recession in 1990 with very minimal impact on the stock market. The big reason for this is that the Federal Reserve, the U.S. central bank, was lowering its interest rate during these periods. When we look at every single time in history where the Federal Reserve was cutting its interest rate, and we look at what happens to stock market valuations during these periods, they go up every single time. This is a chart showing how expensive the stock market is through something called the P/E ratio, and these periods highlighted in red are all the moments where the Federal Reserve was cutting interest rates. In fact, this also happens during recessions. When the Fed cuts interest rates, it means you get a lower yield for holding cash, and so investors allocate less to cash and more of their capital to other assets like the stock market, which causes market valuations to rise. In fact, this is exactly what happened in 1990. During the 1990 recession, valuations were rising during this period. They went from around a P/E ratio of 11 all the way up to 21, so rising by around 100% as the Federal Reserve was cutting interest rates. And given that earnings dropped by 30% in 1990, the rising valuations was more than enough for the stock market to continue rising during this period. For this scenario to happen in the next recession, we would need to see a very gradual decline in stock market earnings, because the stock market doesn't like big spikes down in earnings like 2001 and 2008 that create a lot of uncertainty, and the Federal Reserve would need to cut interest rates throughout 2024, which would push market valuations higher. Currently, stock market valuations are at 22. Historically, we know that valuations can rise all the way up to 30. We saw that happen during the dot-com bubble and also briefly in 2021. If valuations were to rise all the way up to 30, that would be a 36% increase in valuations relative to today. So if that happens, earnings could be gradually moving lower, but the stock market still moving higher. And to everyone's surprise, there would be no stock market crash despite a recession that's dragging down earnings. And then once the recession is over, earnings can resume growing again and never really allow for the stock market to decline. That is exactly what happened in 1990 and why the stock market remained perfectly flat during that period despite the fact that earnings experienced quite a big decline. Now keep in mind, this hasn't happened many times in history. And with valuations currently at 22, they have a lot less room to rise than they did back in 1990 when they were at 12. If you remember on the website, you know that we think rising valuations as the Federal Reserve cuts interest rates is going to be a key theme in 2024, and we've chosen the best bets to make on that. We'll soon be posting our monthly newsletter for the month of February, where we highlight exactly how we think investors should be approaching financial markets today to be profitable. And one big trap that we think most people are not expecting today: earnings continue rising, but that the stock market declines. This is actually something that we witnessed in 1974 and right after World War II. In 1974, businesses saw their profits go up by 50%, and yet the stock market declined by 60% during that period. And the same thing happened right after World War II. Stock market earnings almost tripled during that period as the United States saw the largest boom in manufacturing it had ever seen. But the stock market during that period actually declined by almost 30%. In both of these instances, the stock market was actually getting cheaper despite the economy being very strong. In 1974, for example, the S&P 500's valuations dropped from a PE ratio of around 18 all the way down to 7. So a 50% drop in the stock market's valuation in just those 2 years. Theoretically, that could also happen today. If the S&P 500's valuation were to drop from today's level, which is around a PE ratio of 22, all the way to 7 like it did back then, that would be a 66% drop in stock market valuations. Now, the reason that this happened in 1974 is that the Federal Reserve raised its interest rate from 5% all the way up to 13%. That means investors all of a sudden could get a 13% annual return by just holding cash, which immediately made owning stocks a lot less attractive and pushing down the valuations of the stock market. In fact, every single time that the Federal Reserve has raised its interest rate over the last 60 years, it has always led to lower stock market valuations, and we recently witnessed this exact phenomenon in 2022 when the Fed raised interest rates when valuations were at a PE ratio of 30. Stocks dropped by 25% as market valuations came back down to more reasonable levels. This would actually be the worst case scenario for the stock market because valuations are still very high today and could theoretically drop by 60% from here. But the only way that happens over the next year is if we see the same thing that happened in all of these episodes. If the Federal Reserve continues to raise its interest rate higher than 5%, like it did in the 1970s all the way up to 10%, possibly even higher, if that happens, even if earnings continue to grow over the next year, the market could still be dropping significantly. Of course, it's far from a guarantee that the Federal Reserve will be raising interest rates in such a manner. The only way that this could happen is if we see another wave of inflation over the next year, which the Fed would need to react to by raising interest rates just like they did in the 1970s. When we look at something called the break-even inflation rates, it doesn't seem that they're anticipating that inflation is going to turn up right now. And they do have a pretty good track record at telling us where inflation is going next. During COVID, break-even inflation rates were telling us that inflation was about to surge, which is exactly what happened just a few months later. Then in 2022, they were telling us that inflation was going to come back down. That's exactly what happened. Right now, break-evens are still quite flat, not telling us that we should expect any surge in inflation right now. Of course, that could change. But today, the Federal Reserve has even suggested that they're anticipating they will be cutting interest rates in 2024, not raising them. Today, we're seeing the stock market valuations rise as it already anticipates these Federal Reserve rate cuts. If we continue to see these valuations rise all the way up to 30 before a recession happens, then stocks would have absolutely no protection from any downside in stock market earnings. This was actually the case in 2000, right before the 2001 recession. That's the situation we believe that the stock market is in today. The Fed is cutting interest rates, and so valuations are rising, and that is going to continue. But the higher they rise, the more downside potential you have in the next downturn or the next time that the Federal Reserve raises interest rates. This is one of the most difficult macro environments for investors to navigate through, but there's fantastic trading opportunities that are going to appear in this environment, which is exactly what we strive to help you with at gameoftrades.net.